deposits, right? And what makes it get lower or higher? What makes it increase or decrease reserves? Let's say what makes it decrease. Withdrawals, right? So if somebody takes their money out, so just the opposite. But then maybe even more importantly, how else does it go down? Loans. That's the part that's kind of key, because now we start to get into timing issues, where if I issued a car loan for 5 years, but the person who deposited money comes in tomorrow, I might not have that money if I don't have adequate reserves on hand. So here we had deposits reduced. Somebody came in and withdrew. If we end up having reserves down to 0 and deposits of 9 million, what was the problem? Yeah, and according to who? Or why do we have the Federal Reserve, right? So that's part of the law, is that banks can't get into this situation where it's lower than, they're using 10%. It's kind of a little bit more sophisticated on how much the Federal Reserve requires to be held back. So there's a number of variables. But so we'll a lot of times just use this 10% factor just to illustrate the purpose. All right, so how do we shore ourselves up? We can borrow. Who did we borrow from? I'm just kind of reviewing last time. Who? Other banks. Good. And then who else did we borrow from? Or the Fed. Yeah, so those are our two main places where we can borrow. If I'm Chase, I can call up Wells Fargo and say, hey, spot me 9 million. And that's how it works too. I mean, those banks are doing, we'll look at some numbers later, but spot me 9 million tonight. It literally can be an overnight loan. It might be a 3-day loan, but very, very short-term loans from bank to bank. All right, so what's this one showing? There's the old one again. Here's the new one. Sold $9 million of security. So we called up our stockbroker this time rather than another bank. Instead of borrowing it, we sold off some bonds that we had or some other sort of securities. We sold them, cash got put into our account, our reserves went up to $9 million, and we shored ourselves up again. Here was the borrow from the Fed. Looked exactly like the other one, except that it's labeled with Fed. And what do we do here? Old, new. Called in some loans, or we reduced our amount of loans. That wasn't a good idea typically because why? What's that? Yeah, what about them? They suck, yeah, that can be difficult. Who else can add? They take time, yeah, to get them in, so it might take some time. What else does it possibly create for us? How do banks make money? Interest on those loans. So that's kind of taking away perhaps their most profitable area in terms of how they make money. So that's not a great idea. Your customers, do they like hearing a phone call from their bank that says, hey, we need you to bring some money into the bank, we're calling your loan? No, so that's an immediate way to lose customers and cause some problems longer term for the bank. All right, so this next section looks at asset management. And so this is where we left off. So we want to look for high returns, reduce some risk, and have adequate liquidity. So how do we go about doing that? How do we do this? Number one. What do banks do to do that? Find borrowers who will pay high interest rates and have the low possibility of defaulting. The perfect angel borrower. What do they do? What do those banks do to do that? Okay, run credit scores is one thing. What else do they do? What's that? Check out the income, right. So we're going to check out the 5 C's of credit. So maybe looking at their credit score, their income, their history, so all of that might come part with the credit report. Banks do a lot. If you remember back, I know you got this all memorized, of the average bank's balance sheet. A large fraction of banks do their business with commercial businesses. So how do they find borrowers who will pay high interest rates and have low possibility of defaulting? How do they do that with commercial customers?
New businesses.
Okay, so what do they do? You've had a little banking action, so you might be familiar with it, right?
As far as...
Anybody else work in a bank before Michael got on? You did too? Anybody else? Corbin, was that just an ear thing? Okay, go ahead, Michael. I was just curious if we had other people that...
in terms of new business, generally, since there is no history of credit, you can hike those interest rates up just as long as... I mean, people are shopping for interest rates, obviously.
Yeah, okay, that's... I want to... How do they get these borrowers, though, who will pay... interest rates. I almost hate to use the word high interest rates, but let's just say market interest rates, because they're not out there sharking that they're going to say, if they know the market rates are 6% for a commercial loan, they're going to be somewhere in the ballpark. So kind of take that one with a grain of salt. But I do want to talk about this one more, put more weight into this statement. So find borrowers who will pay a fair interest rate and have the low possibility of defaulting. What do banks do to do that?
Businesses that are established and are not startup businesses.
Okay.
In town for 10, 15
Good. And what do they do with them? What do they do with those established businesses to see if they're possibly a borrower that, and I agree with you, that's a sign, right, that they're a higher quality of just the fact that they've been around for a while. What do banks do? Definitely, but before they do that, before they get to the papers, so how does that go? You can imagine, Rachel, you're working at a bank, and your lender, your boss tells you, the president of the bank says, why don't you go out and make some calls? And so you pick up the phone and you say, yeah, I'd like to see your assets, your balance sheet and financial statement. I'm from so-and-so bank. How does that conversation go when you do it that way? Do they say, oh, sure, I'd love to... Let me just email those right over to you. What do they do instead of that approach? They get there, by the way, eventually.
They court them.
They court them, yeah, good. That's kind of what I was looking for, is that they go out and establish relationships, right? They go to that existing business and they say, hey, John, you've been in town for a while and we've got some new products. Would you mind if I take you to lunch? Oh, sure. Everybody's always up for a free lunch. And so you set a time in the future, and then you get a chance to talk to that person, learn what their needs are, what they're doing. Eventually, you'll get to the point where you want them to open up their books, but you court them, you sell them. A vice president's job is to kind of sell the bank to them, and you want to establish that relationship. So you need to get to know them as part of this area of reducing risk for the banks. So that free lunch that they're giving them isn't so much an expense of food cost, but rather it's an expense of relationship cost. And kind of getting to know you, let me see if I can see who you are and whether I want to lend you money.
I was just going to say, granted, the bank that I worked at, I was in accounting, working a lot more on benefits and stuff like that. But whenever you'd see expense reports come in, like the loan officers are just, they're out at masquerade balls and putting it off to the company and this and that. It's like
I thought you were a banker,
yeah.
Right? And they're definitely not accountants. They are really salespeople of the bank. And a lot of people don't know that, but the the loan officers and the vice presidents tend to be salespeople for the bank. And so, yeah, they have large expense accounts. Mary Lou used to work for a bank. You might not know this. She was a loan officer. I can't remember if she was a vice president or what, but she got criticized by her boss. She said, the boss called her into the office one day and she said, "You're not spending enough money." That's what she said. That's what the boss said to her. "You're not spending enough money," because they looked at her monthly expense accounts on how much lunch was going out and golf outings and whatever, all that kind of fun money. And she's like, "I'm doing my job. I got new business." She was actually one of the top sellers, and her boss wanted to push her more. Take care of these people. That was part of the job. Okay, any other comments or questions there? What do you think, number 3? How does a bank diversify in regard to its what it does primarily, which is the loans, by the way. So I'm not so much talking about buying different maturity bonds and the securities, but their bread and butter is the loan business. How do they diversify? Okay, so like what kind? Let's drill that down deeper.
Types of companies.
Okay, different.
Technology.
Good. So different types of companies is one way to do it. There might be a tech company, a hardware store, a car dealership. Different types of companies. Okay, good. What else?
Houses, mortgages.
Okay, the different types of products that we offer them, right? So real estate, equipment loans, lines of credit. So different types of loans will go out. Okay, good. Any other comments? Diversification. And then we can talk about consumer side versus business sides. All right. So there's my how. Let's see. Balance sheet, liquidity. So what is number 4 talking about? How do we do that? Balance the need for liquidity against increased returns from less liquid assets. What's it speaking to there?
It's comparing we'll talk about like loans, the loans they give out, like how much return they need right now compared to bigger or smaller loans that they don't necessarily need to collect right away.
Okay, and so
They give out too much money that they're going to be able to collect over 30 years compared to money that they're going to be able to collect.
okay, good. Yeah, so it's that timing issue, right? And so what's this balance that it's tell me about what's the possible harm, or if there's not balance, if you will, or what is the balance part? What's the pressures that they face?
It's the same as if you're an individual investor. You want to have money in the long term coming in, guaranteed, and you want to have money short term coming in. If you have too much long term money coming in, your reserves are going to run too low because you're not getting the money back that you need soon enough. And if you have money too quickly coming in, you risk the fact that people aren't going to pay. You're not going to get that money, and you're going to burn it up.
What's kind of the tension that you're describing between those two concepts? So liquidity means what? If you're very liquid, what do you have? A lot of cash, right? So you're sitting fat with cash. What's bad about that? And so what you're saying there is right. Chris is talking about this long-term, short-term. What's the tension created with having a big pile of cash versus returns from less liquid assets? What's the tension? You're not making as much money. That's right. That's the pressure that might come from the shareholders or the bank owners or whatever, is that, hey, I think we should be more liquid because we've got some iffy things in the portfolio. Somebody else in the boardroom says, oh, those things aren't iffy, they're golden. Have you seen that? I think the economy's looking good and we'll be solid. Let's get that money out the door into these longer term assets, right? The longer term stuff. But then that brings in, if money's out and we're running a little bit thin, the bank is more leveraged, it can leave us more vulnerable to downturns in the economy. All right, good. Any other thoughts there? All right, so we've talked about this for the most part here. I think bank capital is that owner's equity, right? The amount that's sitting there in returns, and if the bank is sitting fine, then they can absorb things better. So here's a couple balance sheets. What's the difference? So kind of stick to the, let's take the upper one first here. Okay, so up here we've got deposits, reserves, we're meeting that 10%, we're okay there. We've got bank capital of 4 million, loans of 90. Again, one thing to double check is to make sure assets equal liabilities. We can kind of start to piece it together that way. So deposits, reserves, reserves are the same. Bank capital at 90. So we've got each what we call a $100 million bank. Two examples of a $100 million bank when we look at reserves and loans in terms of volume, in terms of assets. But this is structured a little bit differently. So if we got a $100 million bank, what's the difference? Okay, so what went on down here? Kind of moving from this bank, high bank to high bank. This is the event that happened if we kind of look at new versus old. Here's the high bank situation. Here's the low bank situation. What happened from old, new, old, new?
They did the same thing. They moved their bank capital to deposits because at the end of the day, the bank capital isn't something that is looked on at the bank. The deposit, they have to keep their deposits up to correspond with their reserves. But they don't lose the money in their deposits. They can get that money back and put it in their bank capital if they have to. So they just moved it over to their deposits.
Okay.
To make the balance sheet look better.
All right. Any other comments?
Are we assuming that if bank capital goes negative, then you have a bank failure?
Yes.
Okay.
Yep.
Aren't you just showing what the difference between a rate, like, for example, let's call the top line a regular bank, and let's call the bottom line just a little bit smaller of a bank.
Okay.
If they're keeping their deposits the same and they just have $5 million less in loans, then it's showing how much that changes the game in terms of what you can do with capital.
Right. And if there's a swing in deposits, where is that going to come from too, right? So what does that mean? What does it mean to be negative? Why is that bad? What's that? Yeah, you owe money and it's not there, right? So you're insolvent. What does that mean? Think about the point in time our balance sheet looks like this. What does it mean to be insolvent? Tell me the story that's going on with this one.
Your owners even owe you money at that point.
The owners, yeah, owe who?
You, like the company.
Yeah, they are the company though, so we can kind of think of them almost like a small business, that the owners of the company have this. So who do they really owe? The customers is the thing that we got to look at here, right? Because the deposits are not their money. Somebody put deposits on with the bank. if I was to sell everything I got, can I pay everybody back with the bank's assets? Can I pay all the people that have money at my bank back? No. So that's what the negative capital account means, is that if I was to give up all my $10 million cash, call in all my loans, and magically I'm actually able to get $85 million worth of loans, which of course that wouldn't happen, but let's say you called in everything, 85 million, you've got 10 million plus 85 is 95, you don't have enough money to pay these guys back. So when, at a point in time, if a business, we can talk general business instead of a bank, or an individual, if you can sell everything you got and not have enough to pay your liabilities, you are insolvent. Are you bankrupt? Are you bankrupt? So there's a distinction here between bankruptcy and insolvency. And so not yet might be possible. How?
You still have a chance to get that money back through different accounts that you can bring in.
Okay.
File.
So if we could attract $10 million in deposits tomorrow, are we going to be insolvent? No, it fixes like that, right? Or if the owner said, oh crap, we're insolvent right now, don't worry, I'll cut you a check. I'm a big fat cat with $10 million in my bank account. Writes a check to the bank, boom, it goes into the bank. This jumps from -1 up to $9 million, just like that. But you see how it's kind of similar like a deposit, whether I'm getting outside money from customers or from the owners of the business, it makes the insolvency go away. So what's bankruptcy?
When you've exhausted all of the resources, you can't fix it. You can't fix it.
Yes. So if you're tapped out, if the owner doesn't have any money and business is bad, the insolvency's still there. What makes you bankrupt? Kind of goes back to the income statement. Insolvency is a balance sheet problem, right? We're on the balance sheets here. I don't have enough assets to support my liabilities. That's a balance sheet problem called insolvency. If somebody's bankrupt, what can't they do?
You're not going to get income in.
Okay, so it's related to income. To do what with?
They can't remain above water
As
on
far
a
as
daily basis.
as far as what related to the income statement? What do you do with the income statement? Yes, we like to have income, but the income statement, that financial report, has income at the top, and then what comes next? Expenses. So you have a liquidity problem when you don't have enough income to pay your expenses. You can't service that, but that's on the income side. And the two together might cause you to file bankruptcy. If the creditors are coming after you, then you might have to declare bankruptcy, which is kind of a way to at least pause for the time being the demands that are being made by the creditors. All right, so that those two issues are not easily understood by a lot of people, but that is what the Federal Reserve's job is to monitor this so that banks stay decent with capital. Because the government's monitoring them, do they stay solvent? No. But we try to have laws that say, hey, you got to have a certain amount of capital here. You have to have a certain amount of reserves here. So the bank is, through regulation, telling this particular business, because of these guys, that you have to run it this way. Do other businesses, do they get that kind of regulation forced on them? How do those business owners learn about that? Possibly, the bank might instruct them to say, hey, this is how you should run your business. But how else do they do it?
Just try it and see what works.
Try and see what works. So you fly by the seat of your pants. Or you go to Ottawa University and get a business degree so that you can have that insight going into your first business, right? So if you got that going, that might be a possibility. But my point is, in private businesses, you can be upside down, insolvent, can't pay your bills. That happens all the time. The government's not there to protect you or regulate you, but they are with the banks. All right, we'll pick up there on